Let's talk about what's working in a market that Stanley Druckenmiller says is a raging mania. Actually, let's start there. Do you agree? Are we in a raging mania? What's going on here?
Good morning, Andrew. I think, honestly, if you look beneath the surface at the market action since the March lows, it's actually a pretty rational market. The sectors that have really led the recovery are exactly where people are spending money in a COVID pandemic. It's technology, it's home improvement, it's online retail, it's groceries. So it's much more rational when you look beneath the surface. But with that said, I mean,
Gabrielle,
even those leaders had gotten a bit stretched. So that's what I think is happening.
Right. Well, but let me ask you one question about that, which is, yes, the stocks of companies where people have moved or are moving their money in terms of the Amazons and the Walmarts and some of the big tech companies have obviously the valuations have gone through the roof. The question that I would ask is, is that sustainable money, right? Is that sustainable market share? If you believe that the market is either discounting the future or is looking out 12 months, 18 months out, if you believe that there's some form of a vaccine or something coming, you actually have to hope that people aren't spending the same kind of money at Home Depot, right?
Yeah, exactly. And I think I point this out just to explain that there is a rationality in the recovery off the March lows and that there's a healthy amount of skepticism about the economic recovery. But I would 100% agree with you, Andrew, that we had gone a bit too far into that theme. And so what we've been seeing over the past week or so is some profit taking in some of those names, some right sizing of regional sector and style allocation, exactly to position not just for the COVID reality we're living in right this second, but for the recovery we're going to continue to experience over the next year or two. And we have a lot of interesting catalysts coming up over the next 2-3 months that would be actually, if they occur, much more of an upside surprise for styles like value or sectors like financials than the leaders that have worked so far. So I think it makes sense so far, but it's about bringing a better balance and looking at some of those laggards for a longer term horizon.
What are those inflection points? You said there are 3 things coming up. What should we be looking for?
So I think, first of all, we have the Fed meeting next week. The Fed at Jackson Hole really emphasized how they're changing their tolerance of inflation. But there's a big question mark whether they'll actually act to try to actively generate some higher inflation. Should you get some upside surprise, change in guidance, more QE, that would be an upside surprise much more for the value sector than it is the growth sector. I would also highlight the fiscal discussions or the lack thereof of a fiscal package. That's something that would actually be more damaging for some of the leaders so far. We mentioned a lot of consumer discretionary themes that could be negatively affected there. And then the last thing I would mention is really, of course, the election coming up. And that's something where we could hear a lot more noise in a theme between, for example, tensions between the U.S. and China. And China has really been, along with the NASDAQ, one of the top leaders of this recovery. So taking some profit there and migrating into another region like Europe, which is what has led over the past week.